Get Rich Education is brought to you by Mid-South Homebuyers, cash-flowing turnkey property in Memphis, Tennessee.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 47. I'm your host, Keith Weinhold, and I'm back for another week to help you build your wealth through education, inspiration, and actionable content. Thanks for being here. Why aren't more people into investing in income real estate if it's such a fantastic investment? The answer is that most people don't understand how it generates wealth. It's that simple. You know, I've often discussed how real estate investors are typically paid 5 ways at the same time. Number 1 is appreciation. Number 2 is cash flow from the tenant income. Number 3 is your loan paydown made by the tenant. Number 4 is fantastic tax advantages. And number 5 is an inflation hedging benefit. Now, that 5th one of you benefiting from long-term monetary inflation takes some more understanding, so we're going to dive deeper into that today. Inflation is an increase in the money supply, and that results in you paying more dollars for the same thing over time. All right, so lately you've noticed that the price for a barrel of oil has plummeted to less than half the cost that it was just last year. Well, why does that matter to you in your real estate investing life? Well, oil is the number 1 most traded commodity in the world, and it has a profound effect on world economies and an effect on your economy. And I want to talk about oil's influence on inflation today, too. There are a number of effects of these low oil prices, both positive and negative, on you as a real estate investor, and I want to discuss some of those. This is worth exploring because few economists predict oil prices to significantly rise again for years. Now, one positive effect for you as a real estate investor has to do with your customer, your tenant. They're likely worse off than you financially. Low gasoline prices for your tenant means that they now have more expendable income to spend on things like rent, so it could make it easier for you to get rent increases as they're spending less on all of the energy costs in their life. Now, energy prices like oil are a leading indicator of inflation. Before I move on with inflation, I want you to get crystal clear on why real estate investors with fixed interest rate loans want inflation. Yeah, you want to root for inflation. Fixed interest rate, that means that the interest rate stays the same for the duration of the loan term, usually 30 years, okay? If you have a, say, $300,000 mortgage on a property, look, the value of that $300,000 is diminished over time by inflation because inflation erodes the purchasing power of each of those individual dollars over time. So your $300,000 debt does not rise with inflation. It stays the same. So years from now, the value of $300,000 will really only be perhaps effectively $200,000 in today's dollars. Years from now, $300K won't be worth nearly as much as it is today because prices for everything are going to be higher. That includes your income, which is likely going to be higher. So inflation continues to erode the significance and any drag of your fixed debt amount. Now, your dollar 100 years ago, that's now worth 5 cents, okay? It went from $1 to 5 cents, so your dollar only has 5 more cents to go to become completely worthless. 100 years ago, a $300,000 loan would have had the power of $6 million worth of debt. Well, look how inflation has eroded it to just $300K in today's dollars. So using inflation to reduce your debt over time is a powerful technique that makes real estate one of the best investments. Say that $300,000 mortgage has we'll say a $2,000 monthly mortgage payment. It would probably be less than that at today's interest rates, but we'll just keep it simple. At $2,000, your fixed interest rate loan also means that your $2,000 monthly debt payment, that will not increase over time either. So as the value and purchasing power of a dollar is reduced over time, your $2,000 monthly payment feels less significant all the time because each one of those $2,000 is worth less. Your income goes up, but your $2,000 payment does not. Each dollar is easier for you to earn and spend because it's more watered down and worth less. All right, so just to we'll make an extreme example here, okay, as it takes more dollars to buy the same item over time. When $1 might have bought a rose bouquet 100 years ago for just $1, it now takes $20 to buy a bunch of roses. And in the distant future, it will take a wheelbarrow load of dollars to buy that same rose bouquet. When it takes a wheelbarrow load of dollars to buy roses, that $300,000 loan and $2,000 monthly payment will each be significantly easier to pay down or pay off because each dollar is worth significantly less. Before I got into real estate investing, growing up as a kid, a teenager, I guess I generally did not want to see inflation. I think most people don't. You usually notice inflation when you see the price of things rise. A pound of bananas at the grocery store or the cost of a night's hotel stay. You just kind of gradually notice this over time. You used to see those increases yourself, and then you wondered whether or not your income was keeping pace with those rises in price. This has completely turned around now. As a real estate investor with property tied to fixed interest rate debt, I'm a total inflation cheerleader now. I love seeing inflation reduce the significance of my dollar-denominated debt. Over the long term, say 10 to 20 years, I completely expect inflation to continue just like it has for almost everyone listening to this show over the course of their lifetime. Over the next 5 years, I'm not so sure that there's going to be that much inflation, but over the longer term, yes. All right, here's why inflation should continue over the long term. The U.S. owns the reserve currency of the world, the dollar, the most powerful currency in the world, and the U.S. owes a lot of debt to a lot of people. I'm going to say we because I live in the U.S., okay? We owe China $1 trillion, for example. Well, if the U.S. just cranks up the printing presses and prints more dollars like we have been, then it's easier to pay back China their $1 trillion. We still return China's trillion to them, okay? But back when we made the loan to China, we just never told them what $1 trillion was going to be worth, okay? That very act puts more dollars onto the globe and it reduces the value of everyone's existing dollars that they already have, hurting dollar savers and helping dollar debtors like us. The U.S. owes so much money to so many nations that we have a mandate to want to print. I mean, sheesh. We printed $3 trillion just to pull ourselves out of the 2008-2009 financial crisis, but inflation has still been relatively tame because that $3 trillion has not left the banking system yet. Once that glut of dollars is released out into the economy, we could see significant inflation down the road. That's going to be really good for eroding the significance of the fixed interest rate debt that you hold. Now, since you were a little kid, you know that you've seen higher consumer prices for nearly everything throughout the years, but you might not know why and how you can take advantage of it. Now, whether you like this or agree with this or not, you might as well use this constant dollar devaluation to your advantage, all right? Here's another reason that inflation has been such a persistent force in our economy, and it should continue to be over the long term, okay? Put yourself in this scenario. All right, say that you and I are both running for Senate. You want to get enough votes to beat me, and I want to get enough votes to beat you. I might promise the voters new schools and new highways. Well, you reply and come back by promising new schools, new highways, plus a new hospital. When it looks like you're pulling ahead in the polls and you might win, I'm going to offer even more. I promise the voters new schools, new highways, a new hospital, a social program for retirees, and more playgrounds, okay? Hey, a great way to get elected is just to promise what people want, right? So we're going to say that I won this election and now I'm a senator. Well, now I'm in office. I've got to give people what they want or else I'll be a liar and people will vote against me in the next election if they think I'm a liar, all right? So now I've got to figure out a way to pay for all this stuff I've promised, and I can't raise taxes enough to do that. We all know that raising taxes on people is extremely unpopular, and I would not get reelected. So as a senator, just like all the other 99 U.S. senators, I support policies to have the Fed print more dollars in this scenario, okay? That way, I can pay for all of these programs that I promised to my voting constituency. That's right, I just want to keep inflating away, just like all of the other senators in power, all right? Now, you've seen a tax bill before, but see, you've never seen an inflation bill in your life. These inflationary rises are more subtle and almost secretive, so governments know that they can get away with them. So, yes, there is a significant component of political expediency at work here, and that's just another reason that you've seen prices rise since you've been a kid and why you're likely going to continue to over the long term, okay? You know, when crooks expand the money supply, it's called counterfeiting, okay? But when governments expand the money supply, it's called monetary policy, all right? That's how it works. You know, President Obama has been here in Anchorage this week, so, maybe it seems appropriate to mention the political reasons for why long-term inflation should persist. So when you understand the reasons for why inflation exists, whether you like it or not, now you have a reasonable assurance of more inflation over the long term, and how you're using it, it's going to be power to your advantage by grabbing onto fixed interest rate debt as a real estate investor. And hey, it's really just another reason why I don't desire to pay off my home or my investment properties, and actually why I want to keep those mortgage balances high. Yeah, I am a total inflation cheerleader. With inflation slowly destroying your debt obligation virtually every night while you sleep, consider that most real estate investors are looking at things every month like their property's cash flow. And, you're going to put a lot of interest on that. Did you have any vacancy? Did your tenants pay your manager on time? Did you have any big repair bills at your properties that might have knocked down your cash flow? So your conscience is largely monthly cash flow based. And, really mine is too, by the way. You also might pay some attention to your property's appreciation, but so few think about or really even know about real estate's constant, gradual inflation hedging power when you've got a loan, okay? Despite the near certainty of long-term monetary inflation, there are some shorter-term forces that are trying to trip up inflation here, all right? So, hey, well, one easy way to tie up long-term fixed interest rate debt is if you knew the contact in the number one investor advantaged metro of the last decade, and say that great contact sold you an already renovated single-family home that already had a rent-paying tenant in it, and it was already under management, and they sold it to you at a price where you could generate positive cash flow, making money follow you, all done for you. Real estate has a lot to do with contacts, knowing the right people. Well, you actually do know that contact. It's Mid-South Home Buyers in Memphis, Tennessee. Terry Kerr, Liz Nallen, and the entire friendly team over there. GRE listeners are snapping up those homes. Learn more at midsouthhomebuyers.com or give them a call.
We're Rich Dad Advisors, Josh and Lisa Lannon.
Be who you are becoming. Listen to Get Rich Education with Keith Weinhold.
Welcome back. Like I said, there are some short-term forces that look to slow down inflation, maybe even take a few steps toward deflation. Energy prices like oil are a leading indicator of inflation. Right? Generally, low energy prices mean lower inflation. High energy prices mean higher inflation. All right, so why is that, and why is oil a leading indicator of inflation? What does that mean? All right, oil prices affect the prices of, a lot of things. Say some produce like corn and oranges, because harvesting the corn in the fields and harvesting the oranges in the groves takes energy to drive that machinery for harvest. It also affects the gasoline price that it takes to bring corn and oranges out to market. But you know what? It doesn't work the other way. If a drought wipes out corn or orange yields badly, well, that doesn't affect inflation so much. So it doesn't work the other way. So oil affects those crops, but a downgrade or detriment to those crops doesn't necessarily affect oil. So that's why oil prices are a leading indicator. Lower or higher oil prices affect the price of corn, oranges. Plastics are made of petroleum products, everything from fresh flowers, automobiles, all this stuff, because it takes energy to produce them. Well, now that the cost of production and transportation is lowered with these low oil prices now, that gives producers the latitude to lower prices so that they can compete better, or at least curtail raising of these prices, and that stifles inflation. So oil is a leading indicator because it affects the prices of all of those goods and services. The cost of jet fuel is now sharply lower with these low oil prices, so there is less pressure to raise airfares. Back at the farm, cows eat hay. Lower energy prices means that it's easier to produce hay, so beef price inflation is kept in check. It also costs less to transport beef to market. So lower oil prices are a leading indicator, and that works to slow inflation for the most part. Now, regionally, if you're a real estate investor in certain places, lower energy prices have historically meant slower economic growth in those more oil-dependent economies like Houston, Oklahoma City, Tulsa, and even Anchorage. Now, it's a really significant real estate investing headwind to you if you have property in less diverse economies that are heavily dependent on oil, like the Bakken Shale of North Dakota or the Permian Basin of West Texas, like Odessa and Midland, Texas. Those people face a greater threat of job losses, and you could be looking at vacant rental units in places like that if this condition continues. So that's just one reason I like to buy cash-flowing real estate in the larger metro areas, because their economies are more diversified and can better weather slowdowns in any one business sector. So Dallas and the Texas markets experienced a significant recession in the 1980s when the price of a barrel of oil dropped significantly. But Dallas in particular has such a diverse economy today that, they might be able to make it through this oil price downturn all right. So historically, lower oil prices have meant good things for some cities in the upper Midwest, where there's more auto manufacturing that takes place because consumers are willing to sort of buy more car when gas prices are lower. So now that oil prices are low and inflation has been relatively tame, do tenants need a place to live any less than they did before? No, they don't. They've still got to live somewhere. Some of them might just have to move away from the more energy-dependent markets and into other markets as jobs temporarily migrate there. So what do you think low oil prices mean for distribution hub cities, actually like Memphis, where the busiest cargo airport in the U.S. is located? Memphis doesn't produce much oil, but they consume a lot with the FedEx hub and all the reliant air cargo businesses, railroads, Mississippi River barges, all that distribution right there. Well, it makes it easier for those distribution companies to be more profitable and perhaps even pay higher wages and make more hires, charge higher prices on to consumers. So low oil and energy costs can be good for distribution-based economies. Okay, but one significant message here is lower energy costs overall slow inflation, as there are lower energy costs for all goods and services moved with petroleum products. Now, the likelihood of a bump up to a $15 minimum wage in a number of cities on mostly along the east and west coasts of the U.S., that's likely more good than bad for you as a real estate investor, although there are a few forces both ways. That contributes to inflation with those higher minimum wages, but it's going to take some time for the effect to trickle through. When a company has to pay employees higher $15 an hour wages, one thing they could do is lay off some people and do more outsourcing and automating. But, when they're paying higher wages, they resultantly need to raise their prices now. Think of like Chipotle Mexican Grill. If they need to pay those higher minimum wages, they need to raise prices on their burritos and pass those wage increases on to consumers. When you and nearly everyone else has to bear higher prices, well, pretty soon your wages are going to have to follow to keep up with those higher prices. That can be a highly inflationary phenomenon, diluting the purchasing power of the dollar and making your fixed interest rate mortgage debt easier for you to pay back over time. There will then be significantly more dollars in circulation, so each one of those dollars is going to be worth less. So, one thing to remember is it doesn't really matter whether or not you agree with government intervention in the free markets so much, like with forcing employers by telling them what minimum wage they have to pay employees. A lot of people don't like that intervention. But the point is, when you see it happening, well, now you're learning about how to profit from it, okay? Hey, just one note about inflation in your personal economy here, aside from the real estate for a moment. Note that every human pays a different rate of inflation, every one of us. Your rate of inflation is different than mine, different than your uncle's, different than everybody else's. If you're a vegetarian, you're not affected by inflation on beef and buffalo and chicken, okay? If you're a house flipper, you're going to be more affected by inflation if you buy a lot of lumber products. If there's a lot of inflation on lumber products and you're a house flipper, well, then you're more affected by inflation and you could be paying a higher inflation rate than most everyone else. If you put a lot of miles on your car, then you're more affected by oil inflation or deflation than other people. So, when you realize how long-term fixed interest rate debt can be an asset to you, you can better understand sort of this polarizing and almost controversial Rich Dad quote of savers are losers, debtors are winners. Yeah, when you have smart fixed interest rate debt tied to cash flowing real estate, savers are losers, debtors are winners is often true. I mean, just think about what would have happened 20 years ago if you had saved $10,000 under the mattress or in a bank rather than invested that money. That $10,000 would only be worth $5,400 today, okay? So what can you do to benefit from all this? Here's how you take advantage of it. You have the ability to borrow massively at a fixed interest rate debt and pay it back more easily with inflated dollars over time if you think that long-term inflation will persist. And you have the ability to borrow more easily with real estate than likely with any other investment vehicle because you're often putting down payments of as little as 3.5% typically up to 25% to control an entire property and borrow the rest. And money is still on sale with these historically low interest rates. Yeah, it's just like money is on sale with these low rates. Hey, on the show 4 weeks ago, I mentioned how it's awfully unusual that there was no stock market correction in 4 years, and then we had one shortly after me saying it. I think some show hosts might want to take credit for making an accurate prediction, but I just won't do something like that. It really wasn't a prediction anyway. I mean, the stock market just looked toppy and frothy to me then, and it still does, actually. Hey, be sure to sign up for our free newsletter at GetRichEducation.com. That's where we've now started offering our listeners private buying opportunities not available to the general public for turnkey property. We have done that for those newsletter subscribers for properties in both Kansas City, Missouri and Birmingham, Alabama. And there are more investor advantage markets to come where this will be offered to you. So don't pay the opportunity cost of missing out on our newsletter. Once you sign up, you can unsubscribe anytime. You should be getting a link to a free webinar within the next few weeks that you can attend. And, on the webinar, that way you can ask all the questions that you want to about any of these specific properties that you like. So again, sign up for that free newsletter at GetRichEducation.com. And here's kind of a cool thing. I've got some Get Rich Education logo decals here, and I was considering selling them on the website for a little bit, but then I had a better idea, and that is giving them away to you. I kind of thought we could help each other. If I've ever provided you with an idea or a fresh perspective or anything else of value on this show, would you be so kind as to write a review for Get Rich Education? Just do that, and I will send you a free logo decal. Writing a review on iTunes or Stitcher helps us the most, but I'll happily accept a review on iHeartRadio or the Android app or elsewhere. All you have to do is write the review and send a screenshot of that review and your physical mailing address so the decal can be sent to you. Send that review screenshot and mailing address to info@getricheducation.com. Again, info@getricheducation.com for your free GRE decal. It's kind of a substantial decal. I have one right in front of me here. I'm looking at it. It's got a little sheen to it. It's not paper-like at all. It's about a 3-inch diameter round decal with our competition-winning Get Rich Education logo, and it says the podcast on the bottom in smaller letters. Perfect for placing on your water bottle or wherever. So, yeah, now if someone asks you about how you have monthly income that you don't have to work for, or how you've made a durable stream of income follow you, you won't even have to say anything. Just point to the GRE sticker on your water bottle. I would really appreciate the review. That helps Get Rich Education get more visibility and a higher ranking. So a review would be heavily appreciated because it really helps GRE's profile. So again, if I've ever created value for you with this show or provided you with a new thought paradigm, just do 2 things to get your free GRE logo decal. As long as these decals last, I only have so many of these. Just send 2 things to info@getricheducation.com. Number 1, a screenshot of your review. And number 2, a mailing address to send your decal to. I really appreciate that. Inflation is an almost constant force in our economy. Now you know that you're able to take advantage of it when you own cash-flowing income property with a loan attached. Low energy prices and globalization are tripping up inflation here in the shorter term, but over the long term, governments have a mandate to want to ensure inflation stays in place for programs that they've promised voters and to help repay our foreign debts. Yes, inflation is now your friend. Thanks so much for joining me. I effort to make you more successful than me, faster than me. Now go out there and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.